Sounds good.
Thank you everyone for joining us today. Hopefully those of you who were in this morning's panel are also inside of this workshop. So we're really excited that we're having two events today. I am going to keep it really brief because we have so much information inside of this workshop. I am so excited for you all to learn all of this information with Laura today. I'm going to pass it off to Jess to kick off the event.
Hello, everyone. My name's Jess from FFC. Just want to welcome you guys all to the event. If you want, feel free to throw in the chat where you guys are joining us from or something that you hope to learn during the event today. And with that, I'm going to introduce the event. It's Finding the Right Scaling Model for Your Business. And our host is Laura Keer-nun. She is the CEO and founder of Raising Millions and High Touch Investor Relations. It's a boutique investor relations firm based in New York, providing high quality, transformative investor relations services. So with that, Laura, it's all you.
Excellent. Thank you so much, Jess and Avery. And I absolutely loved that panel earlier. It was a really good setup to what we're discussing today. Thank you so much for having me. I would like to encourage everyone to please just ask questions as we go along, and I will try to answer them. And then that way we can keep this a little bit interactive. And then, of course, at the end, I'm more than happy to answer your questions. And I think we have to wrap up by 2 o'clock Eastern time. So let me start by sharing my screen. Let's see here. Hopefully you all can, oops. Hopefully you all can see that now. Okay. So thank you very much to the hosts as well, to Capital One and the Female Founder Collective for inviting me to present to you today. I'm absolutely thrilled to be here to talk about finding the right scaling model for your business and whether or not you should bootstrap or raise capital. And I think the questions that were answered in the earlier chat, maybe helped you think a little bit more about what your options might be here. So what I'd like to do is just tell you, this is my agenda. I'd just like to tell you a little bit about my company that I founded, as well as the most recent venture that I started called Raising Millions, and about myself and why I'm qualified to speak on this topic. And then I'd like to talk about your business and your growth strategy and maybe ask you some questions that you could think about as you figure out your journey. I call it the capital markets journey. And then what is bootstrapping and when is it appropriate? Versus institutional investor capital raising. And then we'll go through your Q&A and talk to some additional resources. So a little bit about me. I just love this image here of the fearless girl on Wall Street. I grew up in Colorado, and my big dream was to come to New York City and do something big. I didn't exactly know what that was. But I knew I was strong in finance, so I decided to come here and kind of understand Wall Street. That was just really exciting to me. And I wanted to let you know that I am a member of the Council for Inclusive Capitalism with the Vatican. And you don't have to be Catholic to be a member of that. But really what it is it's a movement, I guess, that tries to help ensure that we have a more inclusive, fair, and sustainable, environment, capital markets. And we're committed as HTIR and Raising Millions and myself to helping educate, enable, coach, and guide. And I'm also an angel investor myself. My history really is I have 30 years of experience on Wall Street. I've worked with 4 billionaire founder owners and a lot of founder owners that aren't billionaires too, and been successful raising billions of dollars of capital for companies that you would know, and also maybe companies that you don't know. And I am a guest lecturer at university. So that's a little bit about me. We are launching, I'm so excited, the timing for this is perfect because we're launching a financial literacy course right now. And the reason we are launching a financial literacy course is because after spending the last 3 years working with early stage founders on their capital markets journey, the biggest pain point I have found is related to financial literacy and understanding the capital markets. Most entrepreneurs, all of the entrepreneurs I've worked with, are experts in their field. It can be miniaturized manufacturing at the International Space Station. It can be early stage, cancer research and clinical trials. It can be a vegan food company, you name it, SaaS and AI. These people are all experts in their relative fields, but what they're not necessarily experts at is navigating the capital markets, which can be very tricky. And I have spent a lifetime navigating capital markets and advising founders and executives on that pathway. So we have this website launching in October, actually, but you can still register today if you'd like to take basically an extension of this course today, this workshop. So let's talk about your business and your growth strategy. And one of the questions to think about is, what stage is your business in? I've taken a few models that are out there. You can look at your business in a variety of ways. You can look at it from a revenue stage, pre-revenue, post-revenue. If you're post-revenue, how much is your revenue? And depending upon your revenue and how you are scaling, it will kind of help you understand what stage you are in your business. And that will also translate to some degree to the financing that you will want to have for your business. So, essentially early stage, you're going to be building your business plan. Then you're going to start generating revenues at some point, scaling your business, developing your strategy. You're going to be trying different things and trying to perfect the model. Then you're going to build on that, and you're going to hopefully scale your revenues to at least $1 million. And then you become essentially also probably an employer, and you learn how to transition more towards a bigger business, and you grow and scale. And this is just an image I took from the website, from the internet. And I will really just be focusing on financing for these early stages, the seed stage, the growth stage, and the expansion stage. Here's another look at the various stages of your business, and you can think about it. This helps you think about the fundraising landscape and the financing landscape. I would say when you're early stage, very early stage, as some of the founders spoke about when they were early in the process. Oh, I'm losing my light. Hopefully y'all can see me. They bootstrapped. They basically found a way to finance through their savings, through lines of credit, those sorts of things. And then as some of them grew, they may have decided to raise a little bit of money, which I would call early stage. I'm so sorry, my light is turning off. Hold on one second. I'm going to turn it back on. There we go. Okay. I'm not moving enough. Okay. As you get into this growth stage, you really need a lot of money, essentially. And that's kind of what I'm trying to communicate here, is that depending upon what stage you're in, you'll have different funding needs. And then at some point, investors want to return. So if you do actually get investors into your story, investors will want to return. So you're going to be returning money to shareholders, as well as continually reinvesting and moving on to the next stage. So let me just pause here and see if there are any questions. Oops. Let's see here. Oh, can I put the link? Yes, I will do that towards the end. Thank you for asking. Oh, awesome. Let's see. All right, so I'm going to keep going. Let me get to the, okay. So one of the things that's very important for your business is early on to write your business plan. It's absolutely critical, no matter how you decide to fund your business, to really think through the plan. And I've just copied here the Small Business Association's 2 of their top 10 steps to start your business. And number 2 is write your business plan. And number 3 is figure out how to fund your business. And that's what we're going to talk about today. So what is bootstrapping and when is it appropriate? So bootstrapping is, most of you all know, it's essentially building the company from the ground up with nothing but your personal savings and the cash coming in from the revenue. It also does include traditional business bank financing and business loans, such as lines of credit, credit cards, things like that. And that is, I would put that in the bootstrapping category because you're not issuing equity to anyone, even though you may have some debt financing. When is bootstrapping appropriate? This came up a little bit earlier in the talk, and there are several reasons why I could think of that bootstrapping is appropriate. One is if you are a little bit too early stage and not yet investable. And I know in the earlier panel, I think it was Ika said that you could actually raise money, pre-revenue, pre-minimum viable product, this sort of thing. But I do think it's very challenging to raise money really based on a concept. I have seen founders do it. It's very hard though. You may want to maintain full control of your business. This talks about, this relates to the lifestyle aspect of being an entrepreneur. If you want to maintain full control of your business, you really need to stick with the bootstrapping method, because once you take money from other people, investors, you really are held accountable to them. And while you may be your own boss in your own business, you'll suddenly find that you may report to a board, you have to report to shareholders and even banks. You may want to limit your growth. This also came up in the earlier panel, where if you're not wanting to grow your company exponentially and you want to just have your own little business and maybe stop at 5 million or 10 million or $20 million, that's great. You can do bootstrapping. But if you have an idea that you say, I want to be the next unicorn, a $1 billion business, then, it may be more appropriate for you to raise funds. And you also may just be very fiscally conservative, I would say, and want to fund your business from your own savings and the money that you generate from your business. So now institutional, this is a bit of an eye chart, so don't let it trip you up or anything like this. This is the startup financing cycle. I found this chart and there were some really good articles about startup financing, and there are really, it has in part to do with revenue and time. So as you grow, both in your revenue and as time passes and your concept, your idea, your business, becomes, more of a reality, you may be eligible, so to speak, to raise, different levels of financing. And these are just the different types. So this is kind of, bootstrapping, let's say, over here. And then we have angels. I'm an angel investor, which generally means you're writing check sizes. It can be as small as $100 or up to $250,000, depending on if you're an angel, super angel, what have you. FFF, that stands for essentially friends and family. A lot of times people do what they call friends and family rounds. So you can a lot of times get, 100,000, 50,000, 10,000, whatever the number is, from friends and family to start your business. This is what you call seed capital. There are also a lot of opportunities in the United States as well as Europe with accelerators. Equity crowdfunding, which is really interesting. It's a new, it's not new, but essentially the laws and the rules have changed such that pretty much anyone, any retail investor can invest in an equity crowdfunding campaign, and up to certain limits. And if you have, depending upon how sophisticated your financials are, reviewed, audited, you can raise up to $5 million annually that way through equity crowdfunding. And then you get into the more traditional venture capital raising, Series A, B, C, and so on. And then eventually you may want to go public. So you're transitioning from the private capital markets to the public capital markets, where you do an initial public offering. Like we saw this, this year, I think we've had over 50 IPOs on NASDAQ alone, which has freed up a lot of capital for those venture capitalists to reinvest in other stories. Okay, let me see if we have any questions. Oh, here we go. Maybe let me go back to the prior page here. Okay. And sorry, I don't know if the chat is, I hope the chat isn't covering the screen. I see a question, and I'm sorry if I missed your question, but a question regarding safe notes. Safe notes are really interesting. That is a sort of an instrument that was created by, I believe, Y Combinator, which is an accelerator, very well-known accelerator in the United States. And safe notes are used quite frequently now by founders. And for example, if you have a safe note, you will set a valuation cap, which gets essentially priced on your next more formal fundraise, a Series A or an M&A transaction or an IPO, something like that. And they're really simple. They're really simple. So it's gotten very simple. And actually, I think that's part of the acronym. Let's see. Do angel investors get equity in a business? Yes. Well, it depends. That's a good question. Or is it similar to a loan? You can structure it. So the way that you structure the financing is very important. So an angel investor, for example, one of the clients that I am working with is we're speaking both to debt and equity investors. So debt investors are great if you don't want to give away equity. And on the angel side, a lot of times they will give you very attractive financing terms. They may collateralize your receivables, but essentially it's considered non-dilutive financing, and that can come from angels or even venture. The other thing is that angel investors, it is an equity investment. Again, it depends on how you structure it, but they will expect a return on their investment at some point in time. Let me see here if there are any other. Okay, who would you say is the most qualified to write a business plan? I think I'm going to answer this as the founder, with the person with the idea. And there are plenty of sample business plans out there. Even if you go to the Small Business Association, you can download a sample business plan and fill it out. And I would recommend you do that if you haven't done that already. So let me move on. Oh, wait, let me see. Okay, will investors invest in you if you have credit card debt from investing in your business? Absolutely. Investors will invest in companies that they feel that they can get a significant return on investment from. So that's really the important thing. It doesn't necessarily matter what your cap table looks like, although they will look at it. That's who is your investor, how much you owe others. But that's, in a way, that's to be expected, to have some kind of, like, that you've done bootstrapping before, and that was done either through credit cards or lines of credit. I have a wonderful story about one billionaire founder that I worked with that borrowed $50,000 on his credit card. And I'm not advising that you do that, but I'm just letting you know this story. And he founded a company that is now worth $20 billion. So, founders all have to start somewhere. So you just have to be really careful, I would say. Be very, very careful about, the debt that you do take on. Okay. Let me see. It seems that you're disregarding bootstrapping as a viable, valid option. I think bootstrapping is actually really good. It really depends on how big you want to grow. If you want to, and I think I can mention this, if you want to grow a $100 million business, you might want to consider getting investment. But and you can even build a $100 million business without investment. You can self-finance that too, if you have the means. But I do think bootstrapping is an excellent must way to start. Absolutely. I myself have completely bootstrapped my businesses, and I personally don't want to take any outside investment. That's just me. Because I want to own the whole thing myself and be able to make all the decisions myself. So let me see if there are some additional questions. Oh, do I have any feedback on the pros and cons about equity crowdfunding? Equity crowdfunding is really interesting. I've worked with founders on about 10 different campaigns this year, which is, I don't think we did any equity crowdfunding campaigns before this year. And part of the reason for that is because there's just been such an explosion in interest in, I would say, private investment by retail investors. And you can kind of see this on the public equity market side with Robinhood. Robinhood is a very good example of how investors with smaller dollars really add up. When you get $10,000 $100 checks, that can add up to quite a lot of money. So I would say it's really the retail investor base understanding that the return potential is very high. I think it was mentioned that, they expect 8 or 9 out of 10 early stage investments to fail. That is actually true. So you have to be prepared that if you are an equity crowdfunding investor, that you're looking at 8 to 9 possibly failing out of 10. So it's important to spread it across a lot. But with the Jobs Act, the US Jobs Act, there is so much opportunity in terms of being able to equity crowdfund, and it's very low cost and very low risk. And for the way I look at equity crowdfunding is probably different than a venture capitalist will look at equity crowdfunding. I look at equity crowdfunding as, in a way, it can be like a friends and family raise. So it just makes it very easy for people to invest in you in a small amount or a big amount in a campaign. It's also easy. I think of it as an angel syndicate. So if I think of myself as an angel and I say, hey, I'm going to put $10,000 into this investment, I think it would be a great thing for you to do too. But I don't have to handle any of the money, and I don't have to handle any, excuse me, of the investment docs. Talking a little bit too much here. I don't have to handle any of the investment documents, that sort of thing. So for me as an angel investor, it's really easy and really simple. And I do think it will become more common as people get more educated about equity crowdfunding. So hopefully I answered that question for you. There are a variety of platforms for equity crowdfunding, and what I might encourage you to do also is, I think I mentioned that I am teaching this Raising Millions course in October, and we go into a lot of these different, anything from banking to equity crowdfunding to venture capital raising, because it's quite complicated. Oh, I love this one. Spanx is bootstrapped and still 100% owned by Sarah Blakely. And on the Billionaire, yes, that's true. That is very true. I think it's amazing. Her story, I love her story and her podcast. So I would definitely look into that one. She is a superwoman for sure. And I love Spanx, by the way. For equity crowdfunding, do you need a huge following? That's a good question. When I look at equity crowdfunding campaigns that succeed and ones that don't succeed or don't meet the expectations, there are a few things that, from my experience, that I would tell you, and all of the equity crowdfunding platforms have tons of education on them. So if you are considering that, I would definitely educate yourself. One is marketing. So founders kind of a lot of times underestimate how much work it is. Just because you're doing an equity crowdfunding campaign does not mean it's not work. It's just as much work almost as a venture capital campaign is. It's just, it's a little bit more, it's more for seed. I would say it's for very early stage. You really can't raise more than 5 million doing equity crowdfunding, but you can raise 50,000. And I've worked with founders that have raised, 50, 70, 100, 150,000, and it just gives them that little bit of boost that they need. But the marketing is really important. You really have to, as a founder, it doesn't matter what type of financing you're doing, you have to figure out a way to get in front of investors. It can be socially, it can be through your network. There are a whole variety of ways, but it's very hard. I will tell you that it is very, very hard. And there are a whole bunch of case studies on them, which I can tell you about someday, but you can look up some of the more successful campaigns on some of the crowdfunding platforms, and you'll see that a lot of times they have, they might have a lead investor that, was the CEO at LinkedIn or an executive at Uber or some venture capitalist, that has a name. I would call this like kind of influencer type marketing. It's interesting because I have noticed with the crowdfunding campaigns that it's an open marketplace, and I do see deal sourcing from the venture community, depending upon how open they are to it, through equity crowdfunding, because they can go in and look at all of your documents and your pitch and everything else, and start deal sourcing from there. Let me see. Best way, what is the best way to set financial milestones? Oh, wow. Yeah, so when you put together a business plan or a pitch deck or whatever it is, you'll need to put together a model, basically, is what I call it. And that's my perspective as a finance person. You really need to put together your financial model and figure out, what are the different things you need to grow your business? Do you need a sales and marketing team? Do you need a tech team? Maybe you don't need those at all. So, depending upon your vision, you will put together a model, and that will help tell you what the financial milestones are and how you're going to achieve that, how you're going to execute against that to achieve it. And I always encourage people to dream big. I always say, shoot for the stars, shoot for the moon, and you'll land amongst the stars. So I do believe that, aim really, really high in terms of your growth plan. Okay, so we have, let's see, 30 minutes left. So I'm going to go to the next page and try to get through some more of my slides, and then I'll keep doing some questions, but keep your questions coming. This is great. So let me see. All right, so there are a couple of databases out there that have a lot of information on capital raising, early stage capital raising, private capital raising. This I pulled from PitchBook. You can also, I think there's a free version of Crunchbase you can get. And this just kind of tells you the different rounds. So some of the things some of the different types of financing I was talking about are related to early, anything before Series A. So I would call that pre-seed, angel, bank financing, that sort of thing, which could range, I would say, anywhere from 50,000 to less than 10 million. Once you start getting into the 10 million range, you're really looking at more like a Series A. So you can kind of see the levels here. Average capital of investment, according to PitchBook. And here are some resources for you. So if you would like to learn a lot more about these topics, I will have free resources on my website as soon as it's launched, mostly related to accounting, finance, and storytelling. And that is part of my commitment to the Council for Inclusive Capitalism, is to help educate founders on just getting control of their finances and understanding them. Of course, you can register if you decide to for the course. Also, my boutique investment banking firm, where I actually do raise capital for clients, it's called High Touch Investor Relations. And I will tell you, we're fully booked right now, which is partly why we're doing Raising Millions, so that we can scale a little bit easier. But you feel free to reach out to me there. We are launching our beta cohort, so you get to actually participate in my startup by going to the community. And then I also forgot to mention, I have a podcast, and the first one I think is really the one that you might have interest in listening in. It's called Raising Billions. And episode 1 is about starting your own business, and a little bit about my journey in starting my own business, which I've been in business for 3 years now. Here's a little bit about our community. This is part of my team. So I have a wonderful team that works with me, both here as well as in Canada and Australia. So here's a little bit about them. At the High Line, no less. And I just wanted to say thank you for listening and for And you can follow me and all of our social handles. So now what I would like to do is go back to the Q&A. Oh, wait. So Q&A, I have Q&A and chat. Okay. Okay, so do you have any feedback specifically about the pro cons of, okay, so I got that one already. What happens to an investor's money invested in Series A, B, C if the startup doesn't make its revenue projections? So that's a really good question. When an investor invests in a company, it can be seed, angel, Series A, B, or C. They're taking a risk. It's high risk, but it's also high return. And revenue projections are just that. They are projections. And so I think maybe what you're getting at is the balance of the value of the company, which is in part determined by the revenue, and the value of your investment. So what essentially will happen is if you invest and it's based on a certain revenue projection, and the valuation is set at that projection and the percent that you own of that company, and then they don't meet their revenue projections, the value of the company is lower. It doesn't mean that it's gone to zero. It just means that it's lower than originally projected. And also, if it's higher, it's worth more. So really, it's the value of your investment that declines, at least on a relative basis. You may just make a 10% return instead of 1,000% return on your money. So I hope that helps answer that question. And let me look in the chat here.
Yes, if you all have any last minute cues for Laura, now is the time to pop them into the chat. She has time for a couple more questions before we end week one.
All right, so let me look here. Let me scroll back to where I was. Okay. Okay, is there an ideal debt structure when bootstrapping a business at an early stage? There's a theoretical answer to that, and then there's like a real answer to that. I would say that it depends on what the founder is comfortable with, the management is comfortable with. You really have to decide based on your model and your expectations what kind of debt capacity you should take on. And I would say your business banker can be really helpful in this regard. One thing that I do see often is that founders don't always develop relationships with their business banker. And I think that's one of the first things you should do is go, whoever your banker is, your business banker is, you go and you find out that individual person, because you have to think of them a little bit like an investor too. And they will partner with you, so to speak, on what is appropriate for your business. And I've done this many times with my business. I go down to my little local bank and speak to my banker and tell him, I'm expecting this, but I have to invest that. I have a bridge. I need $50,000 or whatever, whatever it is. And they help me through that. So it just depends. Also, the type of debt is very important. There are ways to get very low interest rate debt. And you definitely want to be very careful of any high interest rate debt. I do know founders at times will prefer equity over debt because in a way it's less risk for they don't have to pay the money back. But in essence, they do through returns, but an investor in equity knows that there is risk embedded in that investment and they may lose the value of their investment. So let me just scroll down here. Can you go out for angel investing for a service company? Yes, absolutely you can. Now service companies, generally speaking, have lower valuations than maybe a tech company. So a service company might be valued at, let's say, 1x revenue. So if you generate $1 million in revenue, the value of your business is $1 million. If you have a SaaS company, you might get a 10 to 20 times revenue. So if you have $1 million in SaaS revenue, software as a service, you're going to get a $10 million value. And you'll have access to more capital, let's say. So you can for sure get angel investing. Angel investing is very personal because it's generally up to the individual angel as to what they do. Let me see here. Okay, so I see someone is saying, oops, sorry. So going from bootstrapping to friends and family to Kickstarter, I saw revenue growth, but mostly sold out product revenues have dropped off. Let's see. So I see a very specific question about a specific business. Generally speaking, this would speak to one answer that I heard in the last panel. I think it was Jamie, about having a plan B. So we all know that things will go wrong. Things almost never work out exactly as you intend them to. So you need to have a plan B. There have been a lot of opportunities through the pandemic for small businesses to get additional financing, either through PPP funding. By the way, early on, people that didn't have their finances in order, their financial house in order, could not really apply for PPP funding. And it really was really hard for me to watch, because these great businesses that should have been eligible didn't have their books and records in place. So absolutely get your books and records in place. Whether you're bootstrapping, getting investors, getting bank financing, whatever it is, you need to get your books and records in place. And I think there's another workshop on that maybe next week. But have a plan B and make sure you have enough cushion to get you through the ebbs and flows. A lot of founders underestimate how long it takes to raise money too. You can easily spend 12 to 18 months raising your first round. And then you have enough runway for your next 12 to 18 months, and you have to start raising for your next round. So sometimes it can feel like a full-time job just to stay funded. It is really, really hard. It's a very challenging path. So I hope that answers the question. Let me see if there are any more questions here. What if you were too big for seed and not quite for Series A, but you want to raise for growth stage? So what I would say is none of these are hard and fast rules. You aren't necessarily too big or too small, but you can do any of those. Let me see if there are any other. Okay, I think I don't know if we've run out of time, but I may pass it back over to Avery to take over.
Yes, thank you so much, Laura. And thank you to everyone who asked such specific questions. I feel like those are really helpful for everyone in the room and everyone who attended, and your answers were so insightful. So I really appreciate that. And I took a couple of notes during this conversation. So I'm assuming that others did as well. And for those of you who attended this event or RSVP'd for any of the events in the 3-week series, you will get access to replays to all of them after following October 7th. So next week we have another lineup for you. So on September 30th, we have a panel talking about money mindset and knowing your worth. So we're talking about things like pricing and packaging and branding. So things very specific to founders within that panel. And then we also have a workshop next week about finding and hiring your financial special forces. So anything from bookkeepers, CFOs, COOs, chairman of the board, bankers, accountants, we are covering it all next week. And then we also, on October 7th, it is our final week of Going for Growth. We have an amazing keynote speaker. And then we also have a workshop about maximizing cash flow without giving away equity. So how much debt is right for you and your company? So I know we had a couple of questions about equity and debt today. All of those will be answered during the week 3 workshop. So I will see everyone next week at the same time. Thank you again, Laura. I really appreciate you being here.
You're welcome. Thank you so much. I enjoyed it.
Goodbye, everyone.
Bye, everyone.